Look, welcome everyone to our Plato Digital Luncheon on what is the future for investing for retirement and dividend income in a lower for longer and post-COVID world. Look, 2020 has been a pretty crazy year, as we all acknowledge, and advisors we certainly recognise have been inundated with webinars and mass digital content. And I think in a normal world, we'd certainly love to be with you face-to-face discussing this important topic. So we thought we would do something different and provide a small number of advisors with a more personalised online experience whereby you have the opportunity to hear from one of Australia's leading investors in the equity income space, have the opportunity to ask questions within a small group. Hopefully you would have also received our Uber Eats voucher, which will complement today's Plato presentation. For those of you who don't know me, my name is Mark Cormack and I'm a Director of Investment with Pinnacle Investment. Pinnacle equity partners and work alongside Plato to distribute their Plato Australian and global income funds to the financial advisory marketplace. And today I'm delighted to be joined by Plato's founder and Managing Director, Dr. Don Hampson. Just in terms of background on Plato, Plato are an independent funds management group that specifically manages money for low tax investors such as retirees. And this is very different to most other fund managers who manage money for clients in all different tax brackets. And because Plato manage money specifically for low tax, it means that they can do things quite differently to other fund managers to deliver that consistent high income portfolio. Suddenly things like portfolio turnover are irrelevant and there's no impediment with respect to things like capital gains tax. Plato will look to buy companies with really strong balance sheets who have the ability to pay income, and then hop out and look for similar future dividend paying stocks throughout the calendar year. But it's important to note that Plato does this without being permanently over high yield sectors or former high yield sectors such as banks or telcos or REITs or infrastructure stocks. But it's also important to note that Plato do have a dual objective. It's also to outperform the ASX 200 on a total return basis and deliver higher income. And since inception, Plato have been able to deliver over 9% income, and they've also outperformed on a total return basis. And especially over the last 12 months when many income stocks have really been hit hard from the COVID environment, Plato have not only been able to deliver some substantial income, but they've also outperformed by over 2%. Look, with that as an intro, I'll hand it over to Dr. Don Hampson to take you through today's presentation. Please, we certainly encourage you to ask any questions you have. However, if you're not asking questions, we ask you to keep your microphones on mute. So with that, I'll hand it over to you, Don, for today's presentation. Thanks.
Thank you, Mark, and good afternoon or good morning, everyone, depending on where you are watching this at the moment. So, yeah, it's an interesting world we live in, and you get new surprises every day, that's for sure. So even Queensland winning the State of Origin was a bit of a surprise last night, but still 2 games to go, so it sets it as a good series for those who follow that. Let's get stuck right into it because we've got quite a few slides, and I'll go through some pretty quickly, but we'll go onto the big picture. And of course, on Melbourne Cup Day, we also got some people got a gift, some people got a bit of a poor gift actually, and that's particularly retirees, because the RBA cut rates again to a very record now low of 10 basis points. For those technically minded, we think that'll be where they'll stop, because the RBA actually pays banks a rate of 10 basis points lower than their official cash rate for banks to leave money at the RBA overnight. E.g., the overnight cash rate for banks is 0.1% minus 0.1%, so 0. So if a Westpac or a Commonwealth Bank actually leave money with the RBA overnight, they get no money at this rate. And I think the RBA doesn't want to charge them money. So probably it's going to stay at 10 basis points for the next 3 years. In fact, the RBA explicitly said in their statement that they are not expecting to increase cash rate for at least 3 years. So we put that forecast into this slide here showing where interest rates have come, and basically they're sitting at 0 for the next 3 years, which is not particularly good if you're a retiree looking to live off earnings from term deposits or cash rates. They're already in negative territory. We haven't actually updated it this year because the inflation numbers have been very strange this year. We had a really wacky June quarter because inflation rates were actually technically negative, They bounced back to be positive in the September quarter. But I think the best number to actually look at is still probably one of the weighted mean or trim mean numbers, which sort of get rid of the outliers. And inflation is actually over 1% if you look at that number, and which means that if you're getting paid 0.1%, you're going backwards much big time. And indeed, if term deposit rates and real overnight cash rates and 10-year bond rates are all less than 1%, then you're going backwards. So it hasn't really changed from the start of the year. So that makes it really hard for retirees to live off the investments from traditional income assets. And so luckily they are able to actually look at other areas to get income, and one is equity income. And we've shown this slide a lot in the past, primarily this slide here as a reason for why we believe even retirees should have some equities in their portfolio for income purposes, because this is a long-term slide looking at the income received from an initial $100,000 investment in the equity market. In fact, right back at the end of 1979 or the start of 1980, whichever you prefer, same basically time. You put 100,000 in, and then we actually capture or track the amount of income that initial portfolio investment generates. But we do this for looking from a retiree's perspective, which is quite different, which we actually we look at the income each year, but we assume that the retiree spends that income, and you don't reinvest it, because most people actually look at an accumulation chart and look at the accumulated value. Here we look really at the annual income generated from that portfolio, assuming you spend that income, but you don't spend the capital. And that has grown nicely from under 10,000 back in 1980 in the first year to over 70,000 in 2019. Now, calendar 2019. This is a gross income, so it actually includes the franking credits on the dividends. But the reason I've put it up now, and I think why it's relevant, is it does show you the time series, and it shows you the path, and it also does show you the volatility. And Mark can just highlight, there are a couple of periods there in the recession we had to have, and more recently, or still 10 years ago now, the GFC, where that equity income stream, whilst it has grown substantially over the last 40 years, it has had two periods, maybe three, but particularly a couple of periods of significant decline. Those declines are worth about 30%, just over 30% in the recession we had to have, but it was, albeit over three calendar years. So dividends actually fell in the Australian marketplace for 3 years in the early 90s after recession. And remember, the recession itself was only a couple of quarters in 1990, 91, but that recession lingered and impacted dividends for the next couple of years. Whereas in the GFC, it was more a sharp decline, particularly in 2008, and about just over 25%, about 26, 27% across 2 years. And that is one of the reasons, not the only reason, why we came out early in April and said, look, this COVID is going to probably impact dividends by around 30%, because historically that's what happened in the two biggest downturns we've seen in the last 40 years. But also, when we looked at individual stocks, and we have a model that looks at the dividend cuts across the market, it was signaling around that sort of level of dividend cuts as well. And happy to say, we'll show this a bit later, but we'll be pretty much spot on with the dividend cuts so far at the market level, but not the stock level. It's quite different. But it gives you a bit of an idea of volatility. So we expect that when we reach add this year into this mix, you'll see a significant cut in dividends, but it will still be a pretty high level. 30% of 70,000 still means you're going to get something like $50,000 income. So, $45,000 income. So it'll still be a pretty high level. And I think that's one of the issues is, whilst we expect dividends to be cut, we still think they're going to look pretty good on a relative basis. So we might flip the next slide and actually go on to that asset class slide, which is slide 9 there. And here we track the annual income generated from the Plato Australian Shares Income Fund as the dark black line at the top, and the market yield. So what you would get if you just invested in the market is the next one down. And you can see that Our fund, the Plato Australian Shares Income Fund, has consistently generated more gross income than the market, but both have tended down over the last couple of years, or the last year or so. I would say that we've actually stripped out the abnormally high yield that we got, in fact, in financial year 2019 out of this series, because there was a number of buybacks and special dividends, which meant it was ridiculous. It was like 15%. It was off this chart, and then that's a completely abnormal situation caused by the franking credit, ALP franking credit policy, that companies flushed out their dividends. So we stripped it back to a more normal situation, but you can still see that it's trended down in the last year or so, as has the market. But what you can also see is that the level of income generated by the Plato Fund is still substantial, and the market for that matter is still substantially more than you can get from typical income asset classes such as term deposits, the cash rate, and investment grade credit, which are the three bottom lines. The higher one is investment grade credit. This is a 3-year series from the RBA. The red one is the term deposit rate from the RBA, which we haven't updated this, but it's likely to go. It's going to go even lower. It's definitely below 1%. In fact, the best rate I can get at the moment is about 0.6% in a term deposit. At a big four bank, you can get some higher ones from other banks, but big four banks, that's probably what you're going to get. And cash rates obviously are now gone to 0.1. So what it's saying is that, yes, you are seeing some erosion in dividends, and that will continue to trend down. We're actually expecting our fund to deliver probably 7% over this current financial year. So it'll come down another % or so from the end of September, end of July, which is when this is calculated. That we still see a substantially higher income out of equity income than most other asset classes. In fact, our 1-year forecast is a couple of slides away, but and in a relative sense, actually, you can go to the next slide. In a relative sense, so this is maybe a bit cheeky, but we've divided the income we receive from our fund, or have paid out from our fund, by the current term deposit rate. And what this slide is showing is that in a relative sense, there's been an actually increase in the amount of income you can get relative to term deposits if you just divide income from the fund divided by the latest term deposit rate. And it's saying a lot more about the fact that term deposits are going to zero, rather than because our fund income is actually slightly declining, but the term deposit rates are declining at a more rapid rate. But when we launched our fund nearly 10 years ago now, 9 years ago, the first year we generated about 200%, about 2 times the amount of income from a term deposit, because term deposit rates were quite high. Now it's generating nearly 10 times, 100,000% more, or 1,000% of the cash rate, which e.g. 10 times the cash rate, so, or the term deposit rate. So, and the market itself has also gone up to about 6 times. So, but it's really saying that interest rates are going to zero, and you can see that from this chart. In fact, this was our forecast before the rate cut, so we'd have to actually trim that now if we made the forecast today at 10 basis points. In fact, we could say that's for 3 years, given they've signalled that. But you're going to get nothing out of cash. You're going to get less than 1% out of bonds and term deposits. So those would all have come down now. In fact, we'll redo those shortly, probably at the end of the year, and bring all those down. Triple B rated credit, we get that series from the RBA, and that has tracked down from 6% 10 years ago to now sub 2%. It's a 3-year series, three-year maturity investment grade credit. Global equity is less than 2, but you still see Australian shares and REITs getting over 4. This is the index level, not our active fund. We expect to get substantially more than that. That is a gross number, though. That does include franking. So we still think equity income gives you good relative income, albeit income from all asset classes has declined. Look, we might just, I've talked a fair bit, just see if there's any questions before we head on to how we manage the money and do things. So, Mark, do you want to open up? Anybody got any questions? Or
yeah, look, guys, feel free to ask Don any questions on the outlook for rates or equity income. So this is a fairly small session, so don't hesitate to ask a question before we move on. Gavin, you've always got a question for me. Anything that you're seeing out there with your clients with income investing?
you have to unmute him, Mark, or?
Yeah, why not? Maybe Gav's muting me. No, all good. Well, maybe we'll press on, Don. And
okay, all right. Don't want to put people on the spot, but we're trying to get some interaction here because otherwise it can be very one way. And I have a feeling that people can tune out. Not that I want to ask you strange questions, but for those who this might be a bit of a slides, probably a bit of a refresher for those existing clients, but anybody who's new to our fund, we actually manage money different, and we manage money for retirees because they are different. Retirees are not accumulators. They're actually in the decumulation phase. They need to live off the income from their investments, so that they like high levels of regular income. In fact, we see a lot of people love our LIC because it's one of the few equity income strategies that pays monthly income, and that seems to be pretty well received. In fact, we're one of the only LICs actually trading at a premium at the moment. The other thing is that retirees are taxed differently, or at least the first 1.6 million in a pension fund is in that it's tax-free, and we try and make the most of that for our investors. We manage our fund from the perspective of a pension phase superannuation client who's in that tax-free bucket. E.g., we try and maximize franking credits, participate in buybacks, but also it means that we're not really worried too much about capital gains tax. The other thing, of course, is that you have longevity risk. You, in that decumulation mode, you have the risk that you might run out of money, and this is highlighted in this slide here. And the problem at the moment is if we've got negative real rates of interest, which we have when you look even at the headline inflation number at the moment, and you're sitting in the low risk cash, I say low risk cash asset, you're going backwards. And even if you had $1 million, if you draw down at the sort of comfortable level, a couple would run out of money before they'd expected to die, and that's longevity risk, and that is the risk that you'd run out of money. Now, obviously, there is a safety net called the pension, and so that would be the grey line, and the pension would start to supplement your income. But it would mean that you would be, virtually fully reliant on the pension income by the time that you your life expectancy hits. But you don't need to increase the return. If you actually go up and just have a target, say an investment, if you had $1 million and we're getting a 4% real return, which isn't that high. I mean, if inflation's say 1%, and a 4% real return is just a 5% return, then actually you can see that you're going to your assets are going to certainly last longer than your expected life expectancy, and particularly when you're after the pension. So it is a risk, but going the safe route can often mean you increase this risk. So there is, I think, an incentive for people, even with a fair bit of money, to look for some risk assets, which probably means some equities, rather than go the safe route, particularly when interest rates are as low as they are now. In terms of tax effectiveness, we find this slide is very popular with clients. I mean, often I think financial planners use this to highlight why our fund is directly appropriate for people in pension phase, because we actually manage from the after-tax perspective of a pension investment, and they are taxed differently. And the fact that these bars are different on this slide highlights that you're not taxed on capital gains, you're not taxed on any income really, but the one thing you can do to improve your after-tax returns, so the biggest after-tax return is a fully franked dividend. If you can get more fully franked dividends, you get that 43% tax refund on a $1 cash dividend, fully franked. ALP didn't get their change that effect, and so you still get that refund. So for retirees, really the only thing they can do to improve their tax effectiveness is seek out fully franked dividends. It's it's a bit different, but not that different, to be honest. For super, it's still the case that fully franked dividends are the most tax effective form of income, or return for that matter, income or return, because we're talking capital gains there. But at the other end, at the top marginal end, then things do change, because you actually prefer albeit not by a lot, but you prefer long-term capital gains. So you actually prefer like investing in property and shares and things for long-term gains. So a buy and hold strategy becomes appropriate, whereas an income-focused strategy is more appropriate for pension and super. So it highlights that they're different, and we are one of the few funds, and still are one of the few funds in Australia that actually manages from that retiree perspective. So I think that makes us different, and it's how that money should be managed for them, which means that we do participate in things like the BHP buyback a couple of years ago. I don't expect there'll be many buybacks in the next 12 months, although you never know. If a company sells assets, they may return capital, but we do look out for these opportunities to pick up good franking credits and pick up good total returns. For every share we successfully sold in BHP in that buyback, we made about 20% relative to selling it on market. E.g., we got 20% higher proceeds because those franking credits are very valuable. And a lot of managers, in fact, most managers I know, don't participate in buybacks. So it does make us a bit different doing that.
So Don, I'll just remind everyone, if you do have a question, just click it in on the questions box, and I can certainly facilitate that and ask that.
Yep. And don't ask Gavin a question because his microphone's not working, man.
No, I'm going to unmute everyone. So
yeah. Now, our strategy to maximise franking credits, we do look for things like buybacks, but we also try and maximise just ordinary dividends that are paid and the franking credits associated with those. And beauty of this, although the pattern's a little bit different this year because a few banks have deferred their dividends or not paid dividends. A few other companies haven't paid dividends as well, but this is the normal spread of dividends across a calendar year, and there's a nice spread of dividends. And that gives us an opportunity as active managers to seek out a lot of dividend opportunities, because we are very active in the way that we buy and sell shares, and we are trying to maximize dividends. And so the way to do that, we believe, is to be quite active and to own stocks when they're paying their dividends. So stocks that might pay or go X in dividends in February and March, you want to be overweight those. But then later in the year, when you might have stocks going X in May, we want to be overweight those. And we can move our portfolio around to capture multiple dividends throughout the year. And the pattern sort of repeated in the second half of the year. And that is why we're able to get much higher dividends than the market consistently. And we believe we can continue to do that consistently going forward, because we actively move our portfolio around rather than adopt a very static buy and hold strategy. And it works very well with the tax situation, because even though we might have our strategy is quite high turnover, turnover is pretty irrelevant if you are in pension phase super, because you don't pay capital gains tax. The reality is we haven't actually distributed any capital gains anyway, because just the nature of the fund, but it's all been income. The other thing, and it's really the beauty of this strategy, is that, and it takes a little while to get to understand this chart, but what we have found, and some other researchers have as well, is that your typical or your average dividend paying stock, so it is an on average concept. If you look at this chart plots every stock that's gone ex-dividend over the last 20 odd years, and it tracks the performance of these dividend paying stocks as they approach their dividend ex date, which is actually day +1, not day 0. Day 0 is the last day on this chart that a stock trades come dividend, and day +1 is the day that it goes ex. And this is a relative performance chart. So we have taken away the returns of the market from the returns of all these stocks that paid dividends. And because the lines are going up, particularly pre the ex date, those dividend paying stocks have a tendency to outperform the rest of the market. Now think about this strategy. We actually buy stocks, we want to own them around their ex dates so we capture the dividends. There's a 45-day rule for tax purposes. You've got to own stocks for at least 45 days around the ex-dividend date to get the entitlement to the franking credits. We purchase stocks a couple of months before they go ex-dividend, hold them through to the ex-dividend date, and then reassess if we want to stay in those stocks or move to another stock to capture a dividend. But on average, those stocks outperform in those couple of months before they go ex, and then their performance tends to flatten out afterwards. So in most cases, we'll sell stocks, might buy a stock for a dividend, get a little bit of outperformance, and then sell it after it's gone ex and move on to something else. And we call this sort of the run-up. the fact that stocks tend to run up. And so we actively trade stocks to capture the dividend, to capture that important franking credit for the retirees because they get that refund, and that tendency of a bit of outperformance in that run up. And that gives us sustainable income and sustainably higher income than the market because we're moving between it. And we can say double dip, but we can get, rather than be overweight, banks all the time, we can move in and out of it between the banks to capture more bank dividends. We don't have to be overweight banks all the time, but particularly in the last couple of years has been a good strategy because banks have struggled big time. But below that, I mean, we do the same things that every active manager says. We look for good value stocks. We look for high quality stocks with good, good profitability, and we also look for stocks with good business momentum. I mean, and there's still stocks in the current environment with good business momentum. As we'll see, that COVID has actually effects have been quite differential between stocks. But I think the last point there is quite important. One of the keys, I think, to income investing or dividend income investing, and probably interest rate investing as well, but it's not us, but is to avoid the dividend traps. You want to buy a stock. We buy it before it goes ex-dividend. We buy it usually before it announces its dividend. You want to make sure they're going to pay a dividend. And the problem in the moment in the market, and there's always a few like AMP, which has been there for a couple of years, but a lot of stocks are cutting their dividends, and they're what we call a dividend trap. Now, Mark's flipped through these slides pretty quickly, but let's take this one, Centra Group. Centra Group owns, the old Westfield Australia. Two things on this chart. One is the price. The price is the blue line, which pre-COVID it was around $4 and very stable. Bang, the impact of COVID was shops were closed. There was rents are under pressure. The clients are under, the clients of Westfield, which are the shops, the individual shops were all struggling. Some are not paying rent on rent holidays, etc. The share price fell away. The historical dividend yield, which is a grey line here, was also very stable at around, and that's the right-hand scale, so it's around 6%. Then as the price of Centra Group fell away, the dividend yield is the inverse of price. So it actually skyrocketed to about 15%. The problem with that increase, or if you think about what's driving the increase in yield, was purely the fall in share price, and the share price fall itself was indicative of problems with the underlying business of Centra, which is the shops are all under pressure at shopping centres due to COVID and a lot less clients. A lot of shops were closed for in lockdowns, and that meant that Centra itself was going to be under future pressure. And not surprisingly, for us anyway, Centra Group actually cut its dividend, didn't pay a distribution mid-year when it normally does. And that is the line that Mark's highlighted, that the historic yield went up until that cut came through. If they don't pay a dividend at the end of this year, actually their yield might fall to zero. So, but certainly their yield is now actually lower than it was. And you can see that AMP's yield, ex that special dividend that was a one-off, has actually dropped from, again, 15% type levels a couple of years ago to nothing now when you look at its ordinary dividend. So these are dividend traps, are really stocks that cut their dividend. So you might have thought you're going to be buying them on a 15% yield, but you end up getting nothing. Another way of avoiding and helping us avoid dividend traps, but also avoiding, I suppose, underperformers, is avoiding stocks that have a lot of red flags. And this chart just highlights that, we have these proprietary red flag indicators, and red flags are a warning sign. The more red flags you have, the lower the performance. And indeed, if you have more than six or more red flags, you probably your annual return over the next 12 months is minus 15%. Whereas if you have no red flags, and there aren't that many stocks with no red flags, you actually have a tendency to go up about 10-ish%. So, you want to be overweight stocks that don't have any red flags, but you want to avoid or certainly be underweight those with a lot of red flags. And that's another way of trying to protect them. The red flags come from all various areas. There's quite a few environmental, social, and governance factors, and a lot of accounting factors and financial distress factors, which, particularly in the current environment, I think has helped us to avoid a lot of the underperformers, which have particularly those struggling in financial distress. And in fact, interestingly, the last year has been a pretty good year for us in terms of relative performance, not absolute. I mean, our fund has actually fallen a bit over the last 12 months, but not that much. I mean, despite the once in a century pandemic, pre-franking credits, our fund has fallen 9%, but if you add in the value of franking credits, our fund has only fallen about 6.8% in the last 12 months to the end of September. These are before fees. And we've done the before and excluding franking and including franking for a reason, because we want to highlight the fact that we pick up a lot more franking credits than the market. In fact, that bottom line there, the active difference, really highlights the sort of franking credit pickup that we have got over the index. The last 12 months, we've generated about 1.3% more franking credits than a market portfolio. Last 3 years, because there's a lot of big buybacks and things, we generated 2% more, and since inception about 1.3%. But importantly, our performance has been quite strong, and indeed we're one of the few equity income strategies that's done well and outperformed the market over the last 12 months. We did that in both parts of the market. We outperformed on the way down, and we also outperformed on the rebound. And we've still been able to generate some pretty high income since inception, over 9% income, including franking, in the last 12 months to the end of September, 7.7% gross income after fees distributed to clients. So still a pretty impressive level of income, and substantially more than the market, and obviously more than the cash rates. Remember, that's just the 12-month looking back cash rate. That will drop to 0.1 over the forthcoming 12 months. So that's sort of an update on our process. Went through that pretty quickly.
So Don, on COVID, Gavin's kindly sent in a question with respect to banks. I know you'll get to that when we specifically talk about banks, so I'll come back to that. But just a reminder, everyone's got the opportunity to ask questions on the questions tab.
Yep. So I think I might answer that as I go through this. So very quickly, and this is an update of where we are, and what we've seen is in August, clearly it was a pretty negative period. Earnings on average were down across almost all sectors apart from IT and materials. And materials is probably, I mean, IT is not that important because it's a small part of our market, and most of those stocks pay no dividends and actually don't earn that much. And quite a few of them don't earn anything. Materials is a pretty big sector though, and its actual EPS change was slightly positive. And basically on dividends, it was zero on an average level, but indeed there were some standouts there. So, but generally speaking, the market, the market impact of COVID was negative, and indeed, most sectors had falls in earnings and dividends. But importantly, and at the overall level, the dividend falls about 30% on an average. But it's interesting that an average hides a lot of differences. The median was less than that; it was only 25%. And on a cap-weighted basis, so big companies weight more than small companies, the actual average change in dividends was less than 20%. And in fact, 22% of companies increased their dividends over the prior year. And that's pretty important. So, whilst there's a massive fall at the market level, you'd say 30% is high, and average fall, there were still some really good pockets of good dividends with 22% of companies increasing them. And some of the standouts were the retailers, the gold stocks, the material stocks like Fortescue Mineral Resources, but also Rio and BHP were pretty good. And the haulage stock, Horizon, and even in financials, which you normally expect them to be knocked down in these sorts of situations, Magellan in particular was a standout with increasing FUM and increasing dividends. So does Steadfast Group. So COVID's really had quite a different impact, and we've had this chart for 6 months now, calling it the good, the bad, and the ugly of dividends, because some stocks are pretty ugly. I mean, Westpac paid no interim dividend and just paid a final dividend that was, more than 50% lower than last year's final. But if you actually look across the whole year, Westpac's dividend was down 70 or 80%. So it was a massive change, and not quite, but nearly as bad for NAB and ANZ. Commonwealth Bank, not as bad, but the best of a bad bunch in banks, but the banks are all struggling. But on the other hand, your Rios, particularly your Fortescue. I mean, Fortescue increased dividends massively versus last year, and So the good ones are really paying roughly similar or higher levels of dividends than previous year. BHP is probably more towards the bad end because oil and gas held it down. But Wesfarmers and CSL and Woolworths all did very well, and even ASX. Albeit stocks like CSL and ASX are not high yielders, so we're not overweight those stocks. But you can see that it was quite a mixed result. Now, digging into a little more detail, and if we just go and looking at the banks, and I know again this is a chart we've held out for a little while, but the banks have performed, and Telstra have performed quite poorly. It's interesting, Telstra's dividend amount, we actually put it in the good category in terms of the dividend that announced in August, but it provided some pretty bad guidance for next year, and which is why its share price hasn't performed all that well recently, but its dividend was actually held up at least this year. But the banks have certainly cut their dividends significantly, and both Telstra and the banks have struggled for the last 3 or 4 years. Take Telstra's dividend, used to be in the top 6 dividend payers in the index, but because it cut its dividend significantly a couple of years ago, it's actually dropped out of the 6, replaced by Rio. And I think it's quite interesting in this environment, just before we go back, Mark, let me just go back to that slide, is that we've managed to outperform the grey line, which is the market, despite the fact that the big income, or the typical big income payers like the banks and Telstra, have significantly underperformed over the last few years. So I think it's a credit to our process that we've been able to continue to keep high levels of income that we generate from our portfolio, but also keep pace with the market, indeed outperform over the last 12 months. So, and even after fees. So it's been a pretty tough environment though for a lot of competitors, because they are, still probably sitting overweight banks. Now, banks are an interesting one, and they've taken a few hits. Not only have they increased their bad debts, but APRA has been looking at them very closely, and in April, pretty quickly on, so within a month of COVID sort of hitting, it actually told the banks and insurers to basically not pay dividends. It said you should defer. It didn't demand them, but it said you should seriously consider deferring dividends. Thankfully, things have turned out better than that initial announcement, and they've now backtracked a little bit and said, okay, look, things are better. You can, but we still expect you to pay no more than half of your earnings as dividends, or retain at least half of your earnings. And indeed, a number of the banks have followed that to the letter. Indeed, Commonwealth Bank and Westpac and ANZ pretty much exactly followed the guidance of APRA in their final dividends. They paid out 50% of their profit, or as near as they can be to 50%. Remembering though that Westpac didn't pay any interim dividend, whereas ANZ and Commonwealth Bank did. Commonwealth Bank paid actually a normal interim dividend because that was prior to COVID, but ANZ's lowered both its interim and final, and Westpac reduced its final dividend significantly, but didn't even pay an interim. So, now the question from Gavin Shepherd was, is there potential for special dividends from banks? Well, I think the answer is, whilst the for that is probably whilst the APRA 50% payout limit is on, they probably won't. But I think the issue is, if we get out of COVID without a lot of bad debts, if most people start paying off their deferred loans and there aren't a lot of bad debts, the banks may be in a position to actually substantially increase their dividends quite quickly in a year or two's time, because one of the reasons the banks have cut their dividends substantially, 2 reasons the banks have cut their dividends substantially. The first one, obviously, is the APRA directive. But the other thing is their earnings are a lot lower than they were last year, because the banks have assumed that they will have a lot of bad debts because of COVID. And so they've increased their bad debt allowances. So that actually reduces their profit now, even though they haven't written off the debt, because everyone's having loan deferrals. There haven't been any bad debts yet, but the banks expect them to be some. Now, if COVID ends up being a lot better than we thought here in Australia, or we come out of that a lot better economically than we thought, the banks can actually write back those bad debts, increase their profits, and actually pay out much higher dividends in the future if we have a good scenario. The bad scenario, which is probably still, I'm still erring towards that, is we haven't really seen the pain of COVID in actual bad debts, because banks have been putting loan deferrals across for small business and for households, and because the government has been paying job seeker and job keeper type payments, we haven't yet had bad debts. We haven't had people foreclose. We haven't had people, or people may not be able to pay their mortgages, but the banks have said that's okay. But next year is where you're likely to see pain. And a couple of banks have already said that. It's like, it's probably next year. So for instance, Combank just the other day actually agreed that they would not foreclose on anyone until September next year. But the problem is, if things are still very tough in September next year, and then they start foreclosing, and we suddenly see a lot of loans being foreclosed, then it could get a lot worse than it is now. So it's going to depend a lot on how we come out of this next year, and it's still, I think, too early to call. Part of that will depend on government policy, how much are they going to extend these things. Part of it will just depend on whether we have second or third waves in COVID and how fast to get the vaccines out. But obviously, there's still things like compliance costs and other things that have increased, and a couple of the new CEOs, like the Westpac CEO, has increased a lot of costs. I think they've taken a bit of a hit to the bottom line this year, so hopefully things can get better. But I think there's two camps still there. We don't know. We've talked about iron ore. It's been fantastic. Fortescue, increased its dividends more than 300% on last year. Went from a final dividend last year, 24 cents, to $1 this year, all fully franked. The BHP dividend was substantially down, but they were very conservative and only had a 55% payout ratio. So, and indeed Rio was pretty conservative too, at a 53% payout ratio. So there's actually some potential for increased dividends from Rio and BHP if they loosen up their payout ratios. But Fortescue is a fantastic stock at the moment. I'm calling it the new bank because it's paying out a huge amount and trading on something like a 14-15% yield, and it's not a dividend trap in our view. We also see the retailers being good, as the gold stocks. I would say gold stocks are still a small part of our market and still pretty low yielders, but they are increasing dividends substantially. And so particularly some of the smaller guys paid quite significant dividends, but they're not high yielders. So in a relative sense, it's still pretty small beer, but we are looking to move into those stocks where we see some good dividends, and they've been good performers because gold price has held up. And then the retailers, fantastic sales results, and they continue to happen actually. JB Hi-Fi, Coles, Super Retail Group, Wesfarmers, they've all had some great results, and those results have continued on into this financial year, the start of this financial year. If you look at JB Hi-Fi's like-for-like sales, 27% in the first quarter. That's unbelievable. Now I think those will start to slow next year because you can't keep growing at those sorts of paces. But in the short term, we've seen some great dividends, great earnings out of some of the selected retailers. Not as good for sort of some of the other discretionaries, the mosaic brands. People aren't shopping for clothes as much, but certainly food and camping gear and those sorts of things, and electronics are going gangbusters as we all work from home. And REITs are an interesting one. I've talked down the likes of Centra and other stocks like that, like Vicinity, but we see some much better outcomes from the likes of Goodman and Charter Hall. In fact, Goodman had their AGM today and gave an update. It was very strong. They're tracking sort of similar sort of 11-12% increase in profit is expectation for this financial year we're in now, but they generated 12% last year and have been good, solid performers. Goodman Group actually benefit from COVID because they own a lot of distribution centres. So they actually have the warehouses. Their sites often have the warehouses for the distribution centres for online sales, and so they're indirectly benefiting from COVID, as are things like data centers and those sorts of things, which are owned by the likes of Amazon and Microsoft. But Goodman Group are doing it by owning warehouses, which is the back end of online sales. And interestingly, you might think, okay, it's a health issue, and so healthcare stocks should all be doing pretty well in COVID. Well, yes, CSL is, and it'll probably benefit from vaccines as well. That hasn't obviously impacted its earnings at the moment. But its earnings are up 10%, its dividends are up slightly. Sonic Healthcare, earnings up 7%, so they kept up with diagnostics. But interestingly, quite a few healthcare stocks struggled because a elective surgery was one of the things that was cut due to COVID. A lot of hospitals stopped doing elective surgery. That's where they make a lot of money. They don't make money from emergency. They make money from elective surgery. And so, Ramsay had a big hit to profitability. And as long as COVID's around and reducing that, then you'd expect their earnings to struggle. And they actually didn't even pay a dividend. So that was a pretty poor result there. So not all healthcare stocks benefit. And of course, there's a lot of dividend traps and a lot of names there. I mentioned Lovisa. Actually, I meant Mosaic Brands, but another retailer which is in clothing is Lovisa, and they struggled, cut their dividends. We talked about banks. Bendigo didn't pay an interim either, and or final actually. And some of the resource stocks haven't done as well. So there was a bit of a cut to South 32, and including anything with tourism. So Sydney airports probably won't pay a distribution for a couple of years, and even Transurban. And I think a year ago we would have thought Sydney airports and Transurban are very safe stocks. They're monopolies basically, and they'll just generate this cash year in, year out. Well, COVID has turned that on the head, and so clearly Sydney Airport, say, is going to struggle for a number of years because it'll be quite a long time before particularly global travel gets back to normal. And even Transurban, I mean, if the more we work from home, the less we drive on their motorways, and so they've seen a substantial hit there. So there's a lot of dividend traps around, but there is some good news here, and we're nearly at the end. But we monitor the average probability of cut across all dividend-paying stocks. And one of the reasons we called a 30% cut in dividends pretty quickly into this pandemic was because we saw this Plato sort of dividend cut model spike in March and then early April, peaked in early April at levels that actually exceeded the GFCs, which is why we expect the dividend cut to be a bit more than the GFC. GFC was about 25, 26%. We're forecasting sort of 30-ish% cuts now. But the good news about this is that blue line there rapidly increased in March, April, peaked though in April, and has actually fallen back. It is still at elevated levels, but it is well below the peak, and actually now below the GFC level. So we think the worst of the dividend cuts has happened, and things should get better from here. Although it probably will take time. So this is our last slide. I think it's pretty clear, and the RBA actually signaled it, but we've been saying this for a while, that interest rates are going to stay even lower for longer. We'd actually been saying we thought it'd be 3 years before interest rates would rise in Australia, and the RBA has actually confirmed that now. We think equity income in that environment still looks very attractive on a relative sense, even though dividends are a bit lower than they were last year. But there are some good opportunities. Whilst a 30% cut across the market, more than 20% of stocks increase dividends, and we still expect to generate around 7% gross income this financial year. But we do think it's a stock picker's market. We think there's still a lot of dividend traps around, and so you've got to be cautious and very, very careful in the way that you buy stocks, because there are still going to be some dividend traps around.
Don, thanks everyone. Look, Andrew Harrison, hi Andrew, hope you're well, and the team at Shadforth as well. Andrew's got a quick question there just in regards to any embedded unrealised capital gains in the portfolio, and just a comment specifically more for, I suppose, those 15% tax rate payers or on low personal tax.
Yeah, we have got some embedded gains in there. In fact, quite a few. I mean, the fact the unit price actually gone up over time is indicative of that it started at $1 and it's well over $1. Well, that's come back a little bit this year with the market. So yeah, there are quite a few embedded gains. Having said that, these are unrealized. We actually are sitting on currently quite a few realized capital losses. We actually have net capital losses in the portfolio, and I think of this in two ways. One is, remember we are a high income fund, so we generate a lot more income than the market. And whilst we've outperformed the market, if you do the sums and you say, well, actually you got, the market has 6% dividends and we're generating, over 9 on average since inception, then we got 3% more income. So if we had the same return as the market, we'd have 3% less capital gains. So we do have a tendency to have a lot more income in the fund. The other thing is, you think about the way we trade the portfolio. We sell a stock ex-dividend. Stock actually falls on the ex-dividend day. When it loses the dividend entitlement, if the share price falls a bit, we sell after it falls. But remember, The chart I showed you didn't show that because that was a total return chart, not a price chart. The price would have shown a fall on the X date, but the total return, you get a dividend receivable and a franking credit receivable, so those offset the loss. But the other thing is we participate in buybacks, and usually the buybacks, the BHP buyback, almost every buyback I've seen, when you sell the shares, you get a capital loss. So we actually have accumulated net capital losses that are realised. So even if we did realise some of the gains that are in our fund, we'd actually have to realise a hell of a lot. Like I think it's something like 20 million. Although don't take that as gospel, but it's a large number. It is more than $10 million in realised capital losses at the moment, which would be used to offset against gains before we'd pay any net capital gains out, and they would be long-term capital gains.
And Don, you haven't paid any gains out since the start of the fund either.
No, we've been going for 9 years, and we haven't paid a single gain out.
Yep. Okay, look, just a reminder, everyone's got the opportunity to ask questions on that Q&A link there. Don, a question I get quite regularly, talking about the resources and iron ore stocks being the new banks or the new dividend plays. Is there any threat with China and the trade war with iron ore, and could that impact dividends in your view going forward, knowing that you're very overweight those three stocks?
Look, obviously I can't, I don't know what the Chinese government's going to do, so I can't rule it out completely. But if you look at what they've done so far, and it seems to add the list is added to almost daily these days in terms of potential limits and tariffs or speculation about them. Iron ore has never been mentioned. The things that they've done it on beef, barley, coal, and wine, and now copper concentrates, so copper from Australia. In all those areas, China can, Australia's a pretty small supplier to China in those areas. They actually, we're actually quite small. In iron ore, China could not survive. They couldn't produce the amount of steel they have now if they didn't import iron ore from Australia. Australia and Brazil are the two major seaborne supply or exporters of iron ore in the world, and our iron ore and Brazil's is high quality. And China needs high quality iron ore because it needs to reduce pollution. That's been one of the things they've been pushing for the last few years, because you go back 3 or 4 years ago, all the stories are about you can't even, you're going to die if you go out, if you've got asthma in Beijing and those sorts of places, particularly in winter. They've significantly improved pollution by closing down production, closing down dirty polluters. The only way you can produce steel and reduce pollution is to use high quality imports, high quality iron ore, high quality and high quality coke and coal, which is why and they can only get that high quality iron ore really from Australia and Brazil can't supply them enough, and is under some challenges at the moment with both COVID and dam disasters. So I really think that they couldn't do it in iron ore. They can do it in every other thing probably, including education and other areas. But we're just such an important exporter of iron ore. It's a duopoly between us and Brazil. They can't do it without us, because India has iron ore, but it's pretty low quality too. So they really need Australian iron ore. So I don't think they're going to impose tariffs or limits, or they would be, if they were very much at the margin.
Okay, look, we are running up against time. We did aim to get this over and done with inside the hour and around 45 minutes. There haven't been any more questions come in, but however, if you do have any more questions, please don't hesitate to contact your Pinnacle distribution partner out there. Look, a couple of key takeouts I've taken out of today's session is that, you do definitely have to do something different in equity income investing. The buy and hold approach, certainly doesn't maximize returns, and it's shown, that buy and hold the traditional stocks like banks and Telstra has certainly underperformed the market very significantly. The case for active management in equity income has never been stronger, and Plato have really shown that with respect to not only being able to forecast correctly the dividend paying stocks, but really importantly, avoid those dividend traps. And the outcome is, there for seeing, the guys have been able to outperform the index on a total return basis. And they've also been able to deliver that consistent, reliable, high income over the index. And as Don is forecasting around about 7% income going forward for the next 12 months in Aussie equity income space, which is a pretty good option when you're looking for retirement income for clients considering where the other asset classes are. So certainly like to thank you for your participation. Gavin, Andrew, for your questions. Really appreciate that. If you have any further questions, please let me know. We will be sending a link for this luncheon out if you want to listen to any of the sessions again, and really appreciate your time today. And thank you, Don, very much for hosting us and lunch and for the presentation.
Thanks, Mark, and thanks everyone for listening.